Every single dollar in your wallet was created out of nothing. Not printed from gold, not backed by some vault full of reserves, just created from nothing. By people you never voted for, never met, and probably never think about. And here's the part that should bother you more than it does. By the time that money reaches your paycheck, it has already passed through so many hands, been taxed, diluted, and marked up so many times that you're essentially receiving the last, smallest slice of something that started enormous. You didn't get in early. You never do. Nobody told you the rules, and the rules were never designed with you in mind. Most people assume money works like this. The government prints it, spends it on things, it flows into the economy, and eventually lands in everyone's pockets more or less fairly. That assumption is wrong in almost every important detail. In 2026, global debt has crossed $300 trillion. That's not a typo, 300 trillion. And yet, across the same world, over 1 billion people live without reliable access to basic financial services. If money creation were neutral, if it were just a technical process, none of that math would make sense. The fact that it does make sense once you understand how money actually enters the system, that's the uncomfortable part. Let's start from the beginning, and this time, the real beginning. Most people think the government creates money, and technically, a small portion of it, yes. Physical cash, coins, paper bills, that's created by the government. In the United States, the Treasury prints it. The Federal Reserve distributes it. But here's what they don't teach you in school. Physical cash is less than 10% of all the money that exists. The other 90%? The money in your bank account, the money in digital transfers, the money moving through the entire economy every single day. That money was created by private banks. Not the government, private banks. And they didn't earn it first. They created it when they made a loan. This is called fractional reserve banking. And once you actually understand how it works, you cannot unhear it. Here's how it works. You deposit $1,000 into a bank. The bank is required to keep a fraction of that, maybe 10%, as reserve. The other $900, they lend it out to someone else. That someone deposits it in their bank. Their bank keeps 10%, lends out $810. That gets deposited again, lent out again, and again, and again. Your original $1,000, through this chain, can become $9,000 or even $10,000 in the broader financial system. Money that did not exist before you made that deposit now exists, created by a series of private lending decisions. The bank didn't have that money. It created it by writing a number into an account. But that's only the first layer, because above the commercial banks, there's another player, the central bank. In the United States, that's the Federal Reserve. In Europe, the European Central Bank. In the United Kingdom, the Bank of England. When governments need money, they don't just print it directly. They issue bonds, basically government IOUs. The central bank then buys those bonds, and in exchange, it creates new money and deposits it into the government's account. Here's the part that sounds like a magic trick. The central bank doesn't use existing money to buy those bonds. It creates new money at the exact moment of purchase. Literally, it types a number into a system, and that number becomes real money. This process has a name: monetary expansion. And since 2008, central banks around the world have done it at a scale that was previously unthinkable. The Federal Reserve's balance sheet went from under $1 trillion in 2007 to nearly $9 trillion by 2022. That's roughly $8 trillion of new money created in just 15 years. Where did it go? That's the real question. When central banks create new money, it doesn't rain down equally on everyone. It enters the system at a very specific point, through financial institutions. The Fed creates money and gives it to banks at near zero interest rates. Banks take that cheap money and invest it. Where? In stocks, real estate, bonds, financial instruments. Asset prices rise. Who owns most of those assets? Wealthy individuals, large institutions, investment funds. By the time that money has trickled down through the system and eventually, maybe, turned into a small business loan or a wage increase for an ordinary worker, it has already done most of its work, inflating the portfolios of people who were already rich. This is sometimes called the Cantillon Effect, named after the 18th century economist Richard Cantillon, who noticed something simple but devastating. Whoever receives new money first benefits the most, because they get to spend it before prices have adjusted upward. By the time that money reaches the last person in the chain, prices are already higher, and the purchasing power of that new money is already lower. In plain English, the closer you are to the money printer, the richer you get. The further away you are, the more you pay for the consequences. And most people are very, very far from the printer. The official narrative is straightforward. Central banks create money to stabilize the economy, keep unemployment low, prevent financial collapses. And there's truth in that. The 2008 financial crisis would have been significantly worse without aggressive monetary intervention. COVID's economic damage was cushioned, at least partially, by unprecedented money creation. But here's the contradiction nobody wants to sit with. The same policies that prevented economic collapse also supercharged asset prices. The stock market recovered in months after COVID, not because working people's lives had stabilized. It recovered because cheap money flooded financial markets. Someone whose wealth was tied to stock portfolios got dramatically richer. Someone whose income came from hourly wages got, at best, a stimulus check. Both things happened at the same time. The economy was saved, and inequality accelerated simultaneously. These were not two separate events. They were the same event, with different outcomes depending on where you were standing in the financial system. Here's where this becomes more than just an economics lesson. The way money is created shapes who has power, who accumulates wealth, and who stays stuck. It's not just about individual bank accounts. It's about which communities receive investment, which industries get funded, which ideas receive capital. When money is created through lending, it flows to people and projects that banks consider creditworthy. Historically, that has meant established businesses over startups, wealthy neighborhoods over poor ones, existing asset owners over first-time buyers. The system doesn't actively discriminate in a simple, obvious way. It discriminates structurally. It rewards those who already have collateral, credit history, and connections, and it quietly, consistently leaves out those who don't. Because the entire policy framework, interest rates, money supply, banking regulation, is built to serve the stability of this same system. The people at the edge of it rarely have advocates at the table when the most important decisions are being made. What's changing? Some things, slowly. Central bank digital currencies are being developed, which could theoretically allow governments to send money directly to citizens, bypassing the banking chain entirely. Some economists advocate direct transfers instead of institutional lending. Some countries are experimenting with sovereign wealth funds that share investment returns publicly. But none of these ideas are anywhere close to becoming the dominant system. The people who benefit most from how things currently work are also the people with the most influence over whether things change. So here's where we land. Money is created every day, in enormous quantities, by institutions most people have never heard of, through mechanisms most people have never been taught. It enters the system at the top, travels through layers of financial infrastructure, grows the wealth of those positioned closest to its source, and arrives at the bottom, already diluted, already inflated, already less powerful than when it started. This is not a conspiracy. It's not a secret. It's simply a system, designed at a specific moment in history by people with specific interests, and maintained by institutions that have every reason to keep it running exactly as it is. The question worth sitting with isn't whether this is fair. That's almost too simple. The harder question is this: if you were designing a system to create and distribute money from scratch, knowing what you now know, would you build it this way? And if not, then who exactly is this system built for?